Japan's currency was just the beginning. A global monetary reset is underway, and it could have a tremendous impact on your investments. Joining us today is Marc Lichtenfeld with the Oxford Club to talk about how this could all impact the U.S. economy, the stock market, and your investments. By the end of this video, Marc is going to share 3 different stock ideas that are perfectly positioned for exactly the kind of economic setup we are in today. Marc, thank you so much for joining us and sharing some of your wisdom with our viewers. So let's start with that broader picture. Let's talk about what is happening in Japan with their currency and the historic move the U.S. made. Why is this such a big deal?
Sure. Well, the yen is the weakest it has been in 40 years. So that's pretty significant. Countries do defend their currencies, occasionally when it gets too weak. But this is the first time in, I believe, about 30 years that the U.S. has joined Japan in defending the currency and trying to prop it higher. So it was a pretty unusual move by the United States, for sure.
We certainly saw some reactions in the market after that move was announced. Let's talk about that ripple effect. Oftentimes we're seeing this referred to as a global reset happening with wealth and the currency markets across the globe. Do you think that the implications really are that big because of this one move with one country?
Perhaps it's a canary in the coal mine, meaning that other countries now know that the U.S. is going to ensure that that other countries don't have to sell their treasuries. And what I mean by that is the reason that the United States came to the yen's rescue is in order to buy yen, Japan needed to sell dollars. And to sell those dollars, they were going to have to sell treasuries to get their hands on those dollars in order to then exchange them for yen. The United States did not want that to happen because a massive sell of U.S. treasuries is going to raise interest rates. As bond prices go down, the rates go up. So the United States wanted to ensure that didn't happen, and which is why the United States then acted, and then bought yen with U.S. dollars themselves. So Japan did it as well, but they avoided having to sell off U.S. treasuries in order to do so. So the fact that the U.S. did that, and it's not the first time they've ever done it, but it's not a very common thing that they do. The fact that they did that perhaps signals to other countries that if they need to take a similar course where they need to defend their currency and prop it up, then perhaps the U.S. comes to the rescue in order to make sure that those treasuries don't get sold.
Yeah, it's an interesting precedent, but I think the reason that you just explained is the key point for retail investors to latch onto here. You talked about interest rates and the concern over rising rates, and that has been such a key conversation in the U.S. The Fed meeting last week sent shockwaves through the market with everyone reacting to that rate news differently. Some were upset that rates didn't lower, some were upset that rates didn't raise. There was a huge reaction to that Fed meeting and the decision to really not change rates. There's lots of speculation about what's going to happen with interest rates from the Fed over the next few months and the rest of this year. So how are these all tied together, Marc?
As far as the currency markets, as I mentioned, if treasuries are sold, rates go higher. And certainly, not just President Trump. I think any president would try to avoid a similar situation. But the president has certainly made it very clear he does not want interest rates higher, does not want the Fed to have to raise interest rates. So, this is a very clear connection between the currencies and overall interest rates, what happened at the Fed. Going forward, it appears that Kevin Warsh, the Fed chair, is okay with letting the markets kind of dictate where interest rates go rather than forcing their hand. And right now, interest rates have been rising pretty steadily without the Fed needing to raise rates, or at least in his opinion. So if the market can kind of take care of that and raise rates and perhaps slow inflation down a little bit on its own, then maybe the Fed doesn't have to take its own action.
So if we are in this environment where interest rates are kind of naturally raising on their own, what does that mean for investors? And that's really the main point of this video that we're talking about today, is offering some guidance on how to best navigate your own investments during this higher rate environment. environment right now. So let's talk about just broadly, what does it mean for investors when you start to see an economy and a market like this right now?
Well, generally speaking, it means that investors have alternatives to stocks because if you can get, a higher rate of interest on a bond, whether that's a treasury or a corporate bond, what have you, which are typically safer than stocks, then some investors will gravitate towards those safer investments in order to get, if not a similar return, but something that's certainly higher than it has been in the last few years without the risk of stocks. And especially right now, I think where, we've got the AI bubble in full effect, doesn't mean that it can't continue to expand for several years and stocks could go a lot higher. But there's certainly risk. And I think there are a lot of people that are concerned that it could pop. We could hit a bear market at any time, really. And bear markets happen whether you're in some kind of tech bubble or not. Bear markets do occur. So having investments where you might be able to earn 5, 6, 7% fixed, where you don't have the risk of the stock market, suddenly gets appealing, especially if you have a shorter time horizon. So that's why interest rates are very much on investors' minds because it can not only give you alternative investments, but sometimes it does take the wind out of the sails of the stock market as well.
Yeah, there's certainly plenty of investors out there who are going to move to safety when there's any kind of canary in the coal mine situation happening. And so more attractive bonds are interesting. But for those investors who'd rather stay in the market, investing in individual stocks, are there specific sectors of the market or specific stocks that do better in this kind of rising rate environment?
Oh, yeah, absolutely. And I'm glad you brought that up because there are areas of the stock market that do well when rates rise. And one of the main areas is financials because typically, the financial companies and a wide variety of different types of businesses in that sector. But for the most part, they very often are investing, whether it's your insurance premium, whether it's your bank deposit, what have you, in fixed income instruments. And so as rates are rising, they're earning more income. Those financial institutions are generating more income from the money that they have collected from their customers. So financials are a great place to be when rates are rising. And we're actually seeing that in the market right now. Financials have really started to pick up over the last few weeks to few months as rates have risen.
Well, that is what you have for our viewers today are three different stocks where investors can turn in these kind of high interest rate environments that can really pay off long term, especially in this environment. And I'm really excited about some of these names that you have for us. I know that a couple of them are names that you have recommended in your Oxford Income Letter. This is your newsletter specifically for your subscribers where you share stock ideas every single month that are all about generating income as investors. And a couple of these names have performed incredibly well for your members. If you would like to join Mark's Oxford Income Letter newsletter, we have a special offer for viewers today. Scan the QR code or click the link in the description to get your special offer to join that Oxford Income Letter now and learn about these stocks when Mark first recommends them so you can see some of these same gains in your portfolio by following the guidance and advice that Mark and his team at the Oxford Club have to share. Mark, let's get to this first name. And again, this first one is one that you have in the past recommended to your followers even a couple years ago.
Yeah, and I still like it. It's Prudential Financial. Ticker symbol is PRU. Great dividend yield, 4.5% yield. They've been raising the dividend every year since 2009. And you know that I love those perpetual dividend raisers, the companies that are raising their dividend every year. So, what I love about those kinds of companies, these dividend growth companies, is it increases your buying power, or at least maintains your buying power in a high inflationary environment where you're getting more income every single year. So I think that's really, really important. As far as the company itself, they're one of the big sellers of annuities. Now, I will say, and I've been on record, I'm not a big fan of annuities as an investment. I know there are plenty of people that like them, and it's one of the reasons I like Prudential Financial. They're quite popular. To me, they are extremely complex. They are expensive, and if you're buying a variable annuity, they have a cap on your upside. So I don't like them as a product, but that doesn't mean I can't like the stock. I don't love tobacco, but tobacco stocks are very good stocks as well. So Prudential Financial is a big seller of annuities, which become more popular as interest rates rise because for the investor, they can lock in a higher rate of return. So as rates are rising, this should be a very, very strong environment for Prudential. Our earnings are projected to grow 32% over the next 3 years. So they've got a really nice fundamental picture. It's dirt cheap. It trades at just 8 times earnings versus 12 for its peers. And kind of a cool thing that they have done, besides for just selling annuities and insurance products, they have acquired pension obligations from some of the largest companies in the United States. We're talking IBM, RTX, the former Raytheon, Lockheed Martin. So, how that works is for a premium. So, the companies pay Prudential a premium, and now Prudential manages these pension obligations and is responsible for these pensions. But as interest rates go higher, they are now making more money on the money that's set aside to meet these obligations. So even though their costs haven't gone higher, they're generating more income from these pensions. The other thing, too, is as rates rise, they are then able to offer cheaper products or services to the companies that want to offset their own pension obligations. So it's really very much a win-win for a company like Prudential.
Yeah, and when you look at Prudential's chart, you can see what you mentioned earlier, that the financials are already starting to get a nice little boost and getting more interest right now from the market, and that is showing up in their chart. There has been a really steady gain the last few months for this stock. It's up 20% in the last year, which, compared to tech isn't a massive gain, but it's a very steady growth stock. And I think it's important to talk about that a little bit more, about why adding in some of these names are important for your portfolio, especially in the kind of environment that we are in.
You certainly want some slow and steady win the race type of companies. When interest rates rise, if they rise quickly, generally that's not great for any company, but tech especially can get hit very hard. So having a financial company or having several in your portfolio typically provides some ballast when things get a little hairy. This stock, like I said, is trading at 8 times earnings. So if we hit a bear market, the floor is a lot closer to the current price than a lot of other sectors, especially tech.
Yeah, let's talk about competition a little bit in this one. I know you mentioned that this is cheap compared to competitors. How does Prudential stack up against the competition as far as business and earnings as well?
Yeah, so Prudential, it's right in there with the rest of the insurers, especially the annuity companies. One of the reasons I do like it is because it is cheaper. Like I said, the earnings growth is expected to be substantial, 32% over the next 3 years. So on average, that's double digits annually, which is pretty strong, especially trading at 8 times earnings. So I love the fact that it's got that big yield and it is cheaper than its peers, while it is still delivering or should deliver a significant growth. And if rates do continue to rise, then those earnings projections, I would think, would only go higher.
All right, a great first stock to look at. Let's move on to the second name that you have for us today.
Sure. So we're going to stick with the financial sector for the second one, and that's Bank of Montreal. Ticker symbol is BMO. And this is a stock that is currently in the Oxford Income Letter right now. So Bank of Montreal is a 2.7% yield. So not a huge yield right now, but it's significant. It's something. But they also raise their dividend every single year for the past 11 years. They operate in Canada and the United States. They have a very meaningful presence in the US. So it's not a pure play for Canada, but it is a Canadian company with a very large presence in Canada, and Canada's rates are rising too. If you look at a chart of their 10-year government bond versus our U.S. Treasury, it looks exactly the same. The numbers are different. Their rates are a little bit lower than ours, but the chart looks exactly the same. So their rates are rising as well. That's going to be positive for Bank of Montreal. I'm bullish on Canada in general. As we've talked about before, I'm bullish on commodities, natural resources in Canada, obviously, very dependent on natural resources. It's a very important part of their economy. So should that continue to do well, that's going to be very positive for Canada. Also, the dollar has been strong the last couple of days, not so much with this intervention in Japan, but for the most part, the dollar's been very strong. That's actually very positive for Bank of Montreal because their earnings are in dollars. So, like I said, they have a substantial presence in the U.S. Those U.S. dollars, when they come over the border and come back to the corporation in Canada, that means more Canadian dollars if the US dollar stays strong. So even though they're not making more money in the US, it translates to higher earnings in Canada. So I really like that. And then also double digit earnings growth like Prudential are expected in each of the next 3 years. So they have a great track record of earnings growth, net interest income, which is uh, kind of the most important way that we measure a bank's performance. That has been rising steadily every year for at least a decade now. So, really, really strong bank in a geography that has a lot of advantages right now with that decent yield that's growing every year.
Few things to unpack from that. One thing that really stood out to me is you noting that interest rates are also rising in Canada. And we started this video talking about kind of a global reset. And it's just another canary in the coal mine of this isn't just interest rates are not just a US discussion right now. This is something happening globally. There's some different cracks showing in different markets all over the globe. So it's something for investors to pay attention to. So that stood out to me. But also just looking at the chart for this one, it has been such a strong and steady growth story. And so many investors are looking for large gains right now. That's what we hear from most of our viewers all the time. And rarely do they look in the financial sector. But if you look at this stock's performance, it's up over 60% in the last year. And this is a finance stock. And so you can find that kind of larger returns in stocks just like this one. Talk about the kind of returns this stock has seen for your subscribers to the Oxford Income Letter when you guys first recommended this stock.
Yeah, so I first recommended Bank of Montreal 3 years ago in May of 2023, so just slightly over 3 years ago. And the position is up over 140% in 3 years. So pretty much hanging in there with technology, which you would not expect from a somewhat of a sleepy Canadian bank. It certainly was not on people's radar, I think, 3 years ago as something that was going to deliver big gains. But kind of one of the things that I have found in running the Oxford Income Letters portfolio for 13 years now, we started in 2013, is that very often some of the stocks that you don't expect are going to be really big winners end up going on these fantastic runs. They're not on people's radar, and then they just they really go crazy. We've had, for example, AbbVie, a drug maker, in the portfolio for quite a long time, and that position is up almost 600% as of we're recording this right now. It's 569%, and this was a time where the stock was kind of beat up. People didn't really like it for various reasons. And I'll be honest, I didn't expect this to become a 5 or 6 bagger myself. I certainly expected the dividend to continue to rise. I expected it to be a steady performer. But that happens sometimes with these dividend payers where you get the right stock in the right sector at the right time, and they'll perform just as well as some big tech stocks, some stocks that you're seeing on in the mainstream media every single day, and nobody's talking about these other names, but they'll put in some big performance. So I'm not against tech stocks at all. If that's what you're into, that's you want that kind of momentum, you can handle that kind of risk, go for it. But you should absolutely have some of these other kinds of names, not only for the income and the income growth, but also because of the performance, because they do take off. Some of them do absolutely put in monster returns.
Yeah, we can absolutely see that with this stock in particular. Such a great name to look at. I think that the first question people have is it's great to see that this stock had some really great returns. If you missed getting in 2 or 3 years ago, is there still a chance to get significant gains as an investor just coming to the table on this stock today?
Yeah, I definitely think so. For the reasons that we discussed, we've got rising interest rates in the U.S. and Canada. That's going to be positive for BMO's earnings. Again, a Canadian economy is pretty solid, and if natural resources are strong, that's going to be very strong for BMO. The currency exchange, if the dollar stays strong. So there are several things that kind of have to continue the way they are for this to kind of really achieve some more liftoff. But even without that, it's definitely a slow and steady wins the race type of investment. Even if those other things kind of reverse or don't have a hockey stick type chart. I do think this is a stock that is going to perform well over the long term, that will provide stability in the portfolio, will provide that dividend growth. And that's worst case scenario. Best case scenario, we do get that really big ramp higher and as it's continued. I mean, you could argue that to some degree this is a momentum stock right now because,
Right.
as you mentioned, it's up 60% for the year. So, uh, there's no reason to think that that's going to stop anytime soon at this point.
Yeah, this one very much looks like it could be considered a momentum trade with how well the stock is performing right now. And you mentioned your performance in AbbVie as well. Some of these names that also generate income also generate some really great gains, as you said earlier. And so if you're looking for more names like this to add into your portfolio, make sure to check out this special offer to subscribe to the Oxford Income Letter so you can learn about these stocks when Mark first recommends them. Again, Mark, some really great information here already. You can scan that QR code, click the link in the description, and get that special offer today. It won't last forever, so definitely go and check that out if you're interested right now. Mark, you've got one more name for us, and I know you mentioned AbbVie already. We're moving on to kind of a similar space.
Yeah, and it really reminds me of AbbVie quite a bit. When I recommended AbbVie, they had the biggest selling drug in the world at the time called Humira, and everyone was worried because it was facing a patent cliff. It was going to eventually go generic, and everybody thought that was going to be the end of AbbVie and their revenues, and basically the company was in a lot of trouble. I argued that that was not going to be the case, that they were going to be able to hold on to their patents a little bit longer than other people expected. Plus, they were a very acquisitive company. They were buying companies, getting new drugs in the pipeline. They're also developing their own drugs. We have the same situation here right now with Merck. Ticker symbol MRK. The biggest selling drug in the world right now is Merck's Keytruda. It's a cancer drug. $32 billion a year in revenue, treats a variety of cancers, including non-small cell lung cancer, melanoma, triple negative breast cancer. But this does face patent cliffs in 2029, I believe. They are taking steps to come up with different formulations to be able to extend that patent, I'm pretty confident they're going to succeed. And Keytruda revenue is not going to drop off a cliff. But they also have 60 other approved products. They've got 50 programs in phase 2 trials, 30 in phase 3, 5 that are waiting FDA approval. But also, like AbbVie did, they are making acquisitions, and they've acquired 2 companies recently that have some very, very strong uh, possibilities for drugs that are in late stage development. One is a leukemia drug. They also will have a new flu vaccine that is what they call strain agnostic. So right now, as you're probably aware, when the new flu vaccine comes out, then they have to make these vaccines months in advance, and then they come out and say, well, this one wasn't an exact match to the predominant strain that's out there. This would solve that problem. This would not to be dependent on that particular strain. So that could be a very big winner for them as well. Other things to like about Merck, a 2.6% dividend yield, raise their dividend every year for 15 years. Earnings are projected to rise 316% over the next decade. So that's going to be a very, very meaningful growth in earnings over the long term. So that's something that you can certainly hitch your wagon to, for lack of a better term, because you certainly want a company that is going to be growing their earnings over the long term, and especially I think with drug companies, which are long term bets. When you're investing in, let's say, small cap biotech, that can be a kind of a one and done thing. You're waiting for an FDA approval or strong clinical trial results. The big pharma, those are much longer term stories, and I think Merck's long term story is really, really bright right now, and people aren't giving it the credit because they're so worried about Keytruda and going off patent.
I like that you already mentioned this is very different than those small biotech companies that we've also often covered on the channel that can have lots of volatility, and one FDA announcement one way or another can, greatly spike or bring down the stock. And this one has so many different names in it that it's a completely different category, really. It's that large pharmaceutical company versus a biotech company with just one or two drugs under its brand. Another thing I wanted to have you talk about with this in particular, you explained how financials are very much connected to raising rate environment. How would a pharmaceutical company like this be impacted by that raising rate environment?
So in Merck's case, it really shouldn't affect it too much. So rising rates aren't going to be a big positive catalyst for Merck. It's kind of it's pretty much neutral. If they have to go out into the market and raise more money, then they might have to pay a little bit more. But generally speaking, nobody's talking about that being a particular issue for them right now. They actually will get a little bit of a benefit. When we were talking about Prudential, I mentioned that the pension obligations.
Mm.
So Merck actually does manage their own pensions,
Huh.
and so rising rates actually are benefit for pensions. It's a little bit complicated with the accounting. It's not a cash benefit, meaning no more cash comes in their door. It's really an accounting thing, but it will add a little bit to earnings. So that number, that bottom line number, should rise slightly as interest rates rise. So it's not the reason that you would buy it. You wouldn't say, "Oh, I'm buying Merck because interest rates are rising," but it's kind of a nice safe place to be if interest rates are rising, and it'll have that tiny little benefit.
Speaking of earnings, Merck just reported earnings today. What do you think about that earnings report that just came out?
Sure. So if you kind of just read the headline, it looks like a gigantic miss, but that was because of some write-offs due to some of the acquisitions that I just mentioned, the two big acquisitions. So the bottom line number, the EPS number, is not particularly important for this specific quarter. They did raise their revenue guidance by a decent amount, so that was certainly very positive. So the stock is up in the morning as we record this. So the market certainly is taking it as a positive quarter for sure.
All right. Well, three really interesting names for our viewers to consider today, and a really great conversation and a really great economic discussion that I think investors need to be aware of and know how it could impact their portfolios coming down the road the rest of this year. Mark, thank you as always for some great guidance and advice for our viewers. Again, if you'd like to learn more from Mark all of the time, make sure to check out that special offer. Again, we've got that link in the description. And check out the last video we recorded with Mark too last month, some other really great names to consider that are all strong, diversified names for your portfolio. You can watch that full interview here.